In stock market, you know that you have a good strategy, that others are profiting well in the market. You also know that you are not the person who are easily FOMO or panic sell when the market is not moving between your expectation. But with a good strategy and good psychological control, if you are still losing money, then this is a video for you. Hello everyone, in this video, I will be sharing about money management in the stock market. While many investors or traders are focusing on strategies to profit from the stock market, but even with the right strategy, many people still fail to achieve consistent profit or even lose their money in the market. In fact, there are three important components to profit in the stock market consistently. First, strategy. Second, psychological control. Third is money management. I would say that psychological control plays 50% role, and both strategy and money management are as equally important. What is money management in the stock market? To make it simple, it is how we manage our capital when we invest or trade a stock, option, future, or any other financial instrument. It includes what is our initial capital to put in a trade, our profit target, and where to put our stop loss. It also includes how we manage our risk-reward ratio. Money management in trading. This part is suitable for the traders who prefer to close their position to take the profit or cut loss earlier. For the investor who are aiming for long-term capital gain for 5 or even 10 years, a different strategy will be applied. I will first start with money management in trading. There are three simple but powerful money management skills. First one, avoid inverted pyramid when adding shares. Let us use this chart as an example. Let's say we have $20,000 capital and there are 5 entry points to enter the trade. To make it easy, let's assume the entry point for these 5 dips are $75, $80, $100, $115, and $120. There are 3 ways that we can deploy our capital. Scenario A, we purchase 10 shares, 20 shares, 30 shares, 40 shares, and 50 shares along the way. This is the summary for the capital required. $750 at the entry of 75, $1,600 at the entry of 80, $3,000 at the entry of 100, $4,600 at the entry of 115, and $6,000 at the entry of 120. Scenario B, we purchase same amount of shares along the way. This is how it will look like. In this case, we purchase 30 shares equally at all the entry points. Total capital use is $14,700. Although we purchase the same amount of shares, the capital required for higher entry price is also higher. Scenario C. In this case, we purchase lesser shares at the higher entry price. More capital, $3,750 is used at the entry of 75, followed by $3,200 at the entry of 80, $3,000 at the entry of 100, $2,300 at the entry of 115, and $1,200 at the entry of 120. Here are the summary for scenario A, B, and C. I have 2 questions that I hope you can answer honestly here. Question 1. Which is your style to use capital to ride the trend of a stock? Question 2. Although the capital used in 3 scenarios are different, but which scenario will give you higher net profit? I will pause 5 seconds for you to choose. At the market high of $140, let us calculate the profit earned and ROI in all 3 scenarios. Scenario A, which we chase the trend by deploying more capital, give us an unrealized profit of $5,050. ROI is 32%. Scenario B, which we purchase same amount of share at each entry, give us an unrealized profit of $6,300 with an ROI of 43%. I hope you will feel surprised for the third scenario. We are using less capital compared to scenarios A and B, but our net unrealized profit is the highest with $7,550 with an ROI of 56%. Does this sound cool? Of course, we always hope the uptrend will always continue without any huge correction. Unfortunately, the correction always comes the moment we are chasing the stock. What if the stock plunges to $100 later? Assuming we never sell any stock, let us calculate our unrealized profit and loss for the three scenarios. For the scenario A, we are now suffering a loss of $950 with a P&L of -6%. For scenario B, we still managed to keep a minor profit of $300 with a P&L of 2%. However, for the scenario C, we still managed to keep a profit of $1,550, a positive of 12% ROI. Let me summarize the P&L for three scenarios again. Scenario A, we increase the capital for each entry progressively. Total capital spent $15,950. At the stock high of $140, the profit is $5,050. ROI is 32%. If the stock plunges to $100, we suffered a loss of $950 with a ROI of -6%. Scenario B, we buy the same number of shares for each entry. Total capital spent $14,700. At the stock high of $140, the profit is $6,300. ROI is 43%. If the stock plunges to $100, we will manage to keep a profit of $300 with a ROI of 2%. Scenario C, we buy lesser number of shares for each entry. Total capital spent $13,450. At the stock high of $140, the profit is $7,550. ROI is 56%. If the stock plunges to $100, the profit is $1,550 with a ROI of 12%. Indeed, scenario C has the highest ROI and lowest risk compared to the other two. Hopefully, this part could show you the power of money management. We do not need to use more capital in order to get higher gain. It is more important for us to use our capital wisely. These three scenarios can be represented with pyramid. Y-axis is the entry price. X-axis is number of the capital spent for each entry. For scenario A, the pyramid is in this shape. We can see that it is an inverted pyramid as we spend higher capital on the higher entry price, while the least capital is used at the lowest entry price. For scenario B, it is also an inverted pyramid, but not as bad as the scenario A. For scenario C, the pyramid shape is the one we see in Egypt, right? We spend the most capital at the lowest entry price and lesser at the higher entry price. Just from the shape alone, which pyramid do you think is the most stable and safe? Even we are not an engineer, I guess we all know that the pyramid C is the most stable. Second money management skill, buying in multiple. This applies to stock, option, or anything else. If I have decided to enter a trade for swing or short term, I prefer to buy or sell in a multiple of 2. Let me use this example as an illustration. For short-term trading or swing trade, stop loss is very important. The price between entry price and stop loss is risk, or R. When my trade goes into my favor and hit 1R, you may consider to sell half of the stock or contract and move the remaining stop loss to the entry price. Then this trade will become risk-free, although it still does not protect the huge gap down or up. When a trade becomes risk-free, we shall just let the profit or the other half run. This approach is more important in psychological control. How do you feel that when your trade is risk-free, we will be calmer in the market and we can also open another trade? I will talk about the third money management skill on the next part of this video. Before you go, please give me a like and see you in the part 2 of the money management video.